Hello, everyone, and welcome on this the Thai Innovator Webinar. Today, the topic could not be more topical with the recent announcement that BlackRock just bought in some Uni token. So the topic for today is how institutions engage with DeFi, custody, access, and opportunities. And for this, I'm really pleased to be joined by an amazing panel, including Griffin from Reserve, Chris from Liquid Collective, Matthew from Altura, and Ayham from Silo Finance. So we'll be going through and discussing how institutions are engaging in DeFi, looking more specifically how they're accessing on-chain markets, how they think about custody and risks that are associated with working in DeFi, how they handle all of that, and where the real institutional opportunity is as infrastructure matures. So before we get started, as usual, quick disclaimer, the information contained in this webinar is for informational purposes only and not intended as investment advice. And without further ado, let's get started. Let's get into it. So we'll do a quick round of our panelists. So to start us off, could you please just briefly introduce yourself, your organization, and where you fit in the DeFi landscape? Who'd like to start?
I'll start.
Matthew, go for it.
Sure. So hi, everybody. I'm Matthew Pinnock. I'm COO over at Altura. And so I've been in the crypto space for about 5 years now. I came in a non-standard way. I came in the ethical hacking and penetration test route. And so that means I'm an original degen. But I ended up reading the Ethereum white paper after a lot of digging and falling in love with the crypto space and with DeFi as a whole. And I ended up spending 3 years at Fidelity, where I was the technical lead over there for their Blockchain Center of Excellence. We deployed Fidelity's first tokenized money market fund with JP Morgan, with ZK Sync, and with a bunch of other different partners. So I'm very familiar with the institutional side of things. I then came over to Altura, and now I'm heading up on tokenization as well as a bunch of other beautiful things.
And next to Matthew, I have Griffin, if you want to go next.
Sure, thank you. Hey everyone, Griffin here. I lead our strategy and market intelligence at Reserve Protocol. Been with Reserve for about 2.5 years now. Reserve is a DeFi protocol that is really a platform to allow companies and institutions to launch indexes of crypto assets. So the easiest way to think about that is like ETFs, but on chain. And so we have a number of different types of products, from broad market exposure to more yield-bearing DeFi positions and stable coins that are simplifying the way people can access yield and abstracting away the complexities of DeFi.
Next, Ayham.
Sure, absolutely. Thank you first. Ayham, the founding contributor at Silo Finance. I've been in the space since 2016. We went live with Silo on mainnet in August 2022. At a high level, Silo is a DeFi lending protocol built around risk isolation. So instead of pooling many assets together in one shared lending market, we isolate each asset so risk doesn't automatically spread across the entire system.
And Chris, go for it.
Awesome. Yeah, thanks everyone. Great to meet you. I'm Chris Matt. I'm the CEO at the Liquid Collective. I've been in the space 8 years as well. I came from the crypto ETF world, helped launch the first Ether staking ETF, and through that process recognized a very clear challenge that institutions have engaging with DeFi and the crypto ecosystem, in that there's trade-offs between yield, like capturing staking yield, the base level yield, and liquidity. Most of these ETF issuers can only stake, 50 to 60% of their assets. And so a lot of these institutional use cases leave yield on the table. And so I joined the Liquid Collective, and the goal of the Liquid Collective is really to unlock capital efficiency at a base layer for institutional participants in the ecosystem. So hopefully helping ETFs stake 100% of their assets, and other institutional use cases maximize both yield, but also liquidity and transferability.
Yeah, and we'll get back into that very, very shortly. So before we go into these themes, what do we mean by DeFi adoptions, right? And like a lot of institutions talk about DeFi adoption. What does that mean in practice? How do you tell the difference between, testing the waters and early experimentations and actual real participation by those institutions?
So I think testing the waters is what institutions have been doing for the past, I don't know, let's say 3 years-ish. And what that consists of is effectively POCs, right? So it's launching a lot of experimentation and a lot of research in the direction that isn't necessarily capital allocation, right? So it's, rather than putting your money where your mouth is, it's deploying technologies on chain that don't necessarily fit to a defined use case, if that makes sense. Where I would say what institutions are trying to do now is, with tokenization, is take their current offerings, take their current instruments, and uplift them by putting them on chain. So I think that's what we're starting to see a lot more of now. That's where experimentation is going, and that's where capital allocation is actually going as well.
I also think it's worth just noting that I still think it's such early days. I think DeFi obviously has been around for several years. It's been mostly a retail phenomena. Most of the DeFi infrastructure up until this point was really designed for more permissionless markets, more retail-oriented users. I think we're obviously at a moment now. I think 2025 was a bit of an inflection point with some additional regulatory clarity and some use cases really starting to emerge. You had folks like treasury companies and others that had large pools of capital that were looking to actually engage more natively on chain. And so I think folks like that are pushing forward the evolution of the capital markets infrastructure in crypto, which is needed. Most of these institutions to actually access DeFi want those access points more frictionless through their already existing points of entry into crypto, like custodians, right? And so you've seen qualified custodians start to integrate DeFi solutions directly into their infrastructure stack, which makes sense, right? That gives the institutional users the ability to engage in DeFi through qualified custodians. So in my mind, there's a lot of that infrastructure that still needs to get built. There's a lot of friction that still needs to be removed to get real integration for a lot of these institutional participants. But I think it's a great thing that it feels to me like that's starting to happen, and those integrations are starting to get built. And that's kind of how Liquid Collective, that's how I look at our position too. It's the more integration we can get into those platforms, the more you can maximize yield for those institutional users while having flexibility to post assets as collateral or put on different structured trades or a whole variety of different use cases. So I think that evolution, unfortunately, it takes a long time. I think it's a multi-year process, and I think 2025 was probably really the starting point.
Right. Yeah. I think to me, it's probably can be summarized by, they start with experimentation, and usually it starts with, using stable coins as settlement rail or testing with limited yield strategies. But we get to adoption when this dip a toe and see if it works attitude changes to basically DeFi being a line item in their treasury management and portfolio strategy. So between experimentation and adoption, there's a lot that needs to happen, basically kind of to become a repeatable financial workflow, like risk limits, monitoring tooling, and internal approvals, clear mandates, and all these things need to kind of to come together eventually to becoming like structured framework and operational playbook for these institutions.
And I'd say on my end, I think a lot of what we're seeing in 2025 and now in early 2026 has been traditional institutions and asset managers like kind of dipping their toes in using DeFi as either an investment strategy or a tool to expand their product offering. You look at a lot of like the headlines around traditional asset managers becoming curators in DeFi as kind of an example. And I still think it's early experimentation, but I think the real test in bridging the gap to adoption will be to look at the inflows of money that follow these headlines, and just actually measuring whether or not the inflows are as big as the headlines are, if the money actually follows.
Agree. I think as well, a good sign of maturity is the fact that we've moved away from things like mirror tokenization to native collateral tokenization, right? So the pipes are starting to actually be built. They're starting to be there. And it means that our market can finally see instruments properly be presented back to us. For example, we can finally invest into digitally native money market funds, a thing we've never been able to do before. This brings institutional yield on chains and provides it to DAOs, So, yeah.
Mm-hmm. And let's start by addressing the elephant in the room, which is kind of funny, right? Like DeFi is built on the premise of you can do all these things permissionlessly. And you can have non-custodial services. All the primitives that are being built can be fully non-custodial. And yet, Chris, you mentioned, right, like the big thing for institutions is how they think about custody, so how do you guys think about institutional grade participation and what does that mean for the liquid staking markets? Where are all the requirements around custody, control, risk management? How do you see this on your end?
Yeah, and I think what you just highlighted is that in my view, I think there's a significant transition that's going to happen or has to happen in the DeFi infrastructure for these institutional users. Like you touched on, DeFi was designed for permissionless, more retail-oriented folks that don't care as much about regulatory posture and compliance, et cetera. And so I think for Liquid Collective specifically, we are an institutional by design product, which means like compliance, regulatory compliance is at the top of our priority list, and it's designed into the protocol by default. So where most DeFi protocols, you can enter and exit the protocol permissionlessly, and there's no KYC AML and there's no OFAC compliance. That's a challenge for institutional users, right? An ETF issuer that wants to utilize, a liquid staking primitive as their base asset in whatever strategy that they're launching, they don't feel comfortable having their assets necessarily commingled with assets of thousands of other users that have not gone through some compliance posture. And so for the Liquid Collective, every dollar that comes into and out of the protocol, it's designed a bit differently. It goes through a KYC AML process because you can only mint and redeem the Liquid Collective products through our partner platforms. So that's like Coinbase and Anchorage and other qualified custodians that have integrated the Liquid Collective infrastructure. So all users have to go through those platforms to mint and redeem. And so there's an embedded KYC AML OFAC compliance posture that's already implemented as part of the product. And so that's like a key differentiator. And I think we'll probably see more like other creative ways to check that box for institutional users for other protocols as well. I would also note that another challenge is, I think in DeFi, everyone talks about decentralized governance and it's another thing that institutions aren't totally comfortable with. They may want some level of control. And so the Liquid Collective is designed more as an institutional consortium model, where the institutional participants that are owners and participants in the product have some level of control and oversight over sensitive decisions that are made, but it's not controlled or owned by any one party. And then lastly would just be maintaining neutrality. I think we're going to see a lot of branded solutions and integrations to specific platforms. We've very much prioritized and focus on maintaining a neutral stance so we can integrate across the entire ecosystem. And I think all these things are critical, especially in light of look at what happened with 1010. You had certain exchange implosions and depegs, and so having a more institutional grade infrastructure, I think, is critical to get these participants involved in the ecosystem.
Yep. And in Griffin at Reserve, you guys work closely with stablecoins and treasury-backed assets, right? And so from an institutional perspective, what custody models are getting traction today?
Yeah, I'd say custody is still one of the largest gating factors for institutions, and when they realize that interacting with DeFi often involves self-custody, and we're seeing a spectrum of models gaining traction. I mean, on the more traditional end, there's the qualified custodians that have segregated accounts, and crypto exposure fits into more of a traditional TradFi asset custody model. But a challenge with a lot of these, I guess, setups is the flexibility to interact with DeFi natively. And what we're seeing is a lot of them invest in trying to integrate some DeFi products natively into their apps and their kind of custodian environments. And then increasingly, there's more hybrid models where I'll say it's either multi-sig or MPC setups that outsource certain operational and compliance layers. And a lot of these wallets will offer a lot more flexibility to have embedded DeFi products that can be accessed directly in the environment and natively in the interface. And I think these are where more of the forefront, more DeFi forward institutions are accessing it. And then finally, on the kind of furthest, most crypto native end of the spectrum, there's self-custody in multi-sigs and interacting completely on chain and with the DeFi protocols natively.
Yeah, and when it comes to you, Matthew, at Altura, what do you guys see? I mean, you also work with stablecoin issuers like USDT Zero, but also real world asset like gold. What do you see in terms of institutions participating in that space, either trading, lending, if they have anything to add on the custody side, but also on the controls, maybe?
Yeah. So as far as real world assets go, I think there's still quite a lot to be done, both on our side and on the institution side. I think for us as crypto natives, it's primarily getting comfortable with their processes. So for example, at Fidelity, we had a very, very large KYB and KYC process that we figured out most votes, most DAOs just couldn't go through. And that was the stopping point for a lot of different places. It's simply not having the team to be able to go through the bureaucracy. However, it's something that I think we need to get a lot more comfortable with if we want to get access to these new primitives. I think DeFi is kind of begging for new primitives at this point, in the sense that we have liquid staking, we have a bunch of primitives that we know and understand work, but that are also battle tested and tried primitives that have been working for years, right? And they do, in some cases, beat the yield that we're able to offer at volume at the same scale that crypto offers. I think this is why Altura's strategy has taken a massive bet on RWAs because we believe that value is pumped back into the real world. And I think that's what institutions want to see, rather than rehypothecation until liquidity is basically dead or an account blows up. They want to see value either going back into the private credit markets or into the commodity markets, into something that's like tangible. And so you mentioned gold, and I think one of the biggest things that we haven't tapped into yet is the ability to tokenize tangible assets. So that's gold, that's coffee grounds, that's livestock. I think TradFi hasn't done that yet because of the fact that their pipes are just too slow. They're too slow to do tokenization of a money market fund, which is just a TA and a CSD and some paper going around. So there's still facts in some of these systems. Whereas commodities networks are much, much more complex, which is where I think crypto can step in, or which is where I think DeFi can step in, because we have oracles, we have nodes, we understand how to attest for an asset in an efficient way, in a way that TradFi doesn't. And I think this is increasingly what TradFi is piggybacking on crypto to do, and what they're experimenting with the DeFi markets to do. So,
yeah, and I mean, Ayham, you also mentioned, right, like the controls and being able to get protections, multi-sig aspects, etc. And at Silo Finance, you use risk-isolated lending markets, right, where each asset sits in its own pool, which is very different from models like Aave or Compound. How does that change the conversation when you discuss with those institutions about risk for DeFi lending?
Right. Well, it changes it a lot. So, in typical traditional shared pool lending, institutions are exposed to the systemic risk that comes from all the assets, because all assets share the same liquidity base and collateral structure. So if you're exposed to one asset, only if you want to, an institution wants to an exposure to one asset only, it's not possible in traditional lending. So when we introduced Silo back in 2022, we actually validated risk isolation vertical in lending. Basically, what we created this isolated lending market. So now risk profile is cleaner and easier to underwrite for institutions. So it's something goes wrong in one market, bad oracle, credit like liquidity crunch, collateral collapse, which we have seen. On October 10th. Because of that, it doesn't automatically translate to a systemic collapse in unrelated pools. So this particular feature, risk isolation, maps exactly well to institutions, because they think that risk should be compartmentalized and exposure should be deliberate. So you should choose your risk exposure to the collateral. And now we are introducing Silo v3 in about a few weeks, where we actually we introduce a liquidation mechanism that changes the entire lending landscape, in the sense that you no longer need DEX liquidity to protect the solvency of the protocol. So if something goes wrong, let's say redemption is closed, or simply liquidity doesn't exist because the asset doesn't have AMM liquidity at all because it has fundamental values off chain, Silo has a mechanism to actually protect lenders. So that opens up credit markets to really any asset that has fundamental values. And maybe later I'll tell you a little bit more details about Silo v3.
Yeah, for sure. And the big aspect, right, to access those markets and being able to do anything is DeFi is this is what finance is built on. Is you need a layer of liquidity, having very liquid markets that are easily tradable and deep. And so I want to go back to Griffin at Reserve on this, because stablecoins have been a major way to on-ramp and off-ramp capital flows to DeFi. And you guys obviously sit at the intersection of stablecoins and real-world capital flows. How are institutions using stablecoins to either access DeFi liquidity, or are they using something else? And what advantages do stablecoins have relative to other traditional financial rails?
Yeah, I think institutions are really using stablecoins as that primary bridge to access DeFi markets. Stablecoins plus DeFi protocols and primitives can offer 24/7 liquidity, easier access to leverage, instant settlement, reduced counterparty risk, and kind of all of the benefits of on-chain finance. I think in many cases, institutions are also realizing that on-chain stablecoin vaults open up their asset management universe to a wider pool of capital, including retail investors, and so it can actually lower their cost of capital. And then some more advantages beyond kind of what I've mentioned are higher transparency into the backing, so of whatever strategy they may be implementing, and so that reduces reporting costs, and it also just increases trust with their investors. And so I think ultimately what we're seeing is a lot of institutions using DeFi in a stablecoin native way, because that's kind of the simplest step. And then as more assets get tokenized, more RWAs are brought on chain, I think we'll see the advancements continue to make towards other non-dollar denominated products.
Yeah, and once you're there and you've bridged the ramp to get to DeFi, obviously a big thing that institutions want to do is get yield, right, and access new different types of yield. And Chris, you mentioned being able to open this up for ETFs, but before we get into this, I want to touch on this with Ayham and Matthew on what are institutions actually trying to access when it comes to on-chain yield.
Right. Yeah. I mean, in our experience, having spoken to many institutions, it's really usually less about chasing the high yield. It's more about predictable return streams if they can find them. So I can summarize them in really few strategies, to be honest, because I think institutions are still more like we've established, like more testing right now. So market neutral yield with stable coins, of course. Basis, funding rate opportunities if they find them on multiple chains nowadays, not necessarily on Ethereum. Structured lending strategies, we've seen that a lot, and in probably fewer cases, more of diversified vault strategies. But if you can establish transparency behind these strategies, which can be a little bit difficult to understand nowadays, especially when they extend beyond on-chain.
I think from my perspective, what I've seen, and to echo Ayham's sentiment, is institutions are after not necessarily crazy yields, but I think diversified portfolios that are out of the scope of what they currently own, right? So I think that's more exotic primitives. So for example, tokenization of gold, or tokenization of gemstones, which is actually better, is something that isn't on the Bloomberg terminal. And so as such, it's something that institutions don't have direct access to, right? So I think by creating and allowing for access and settlement of these exotic primitives, we allow a lot of things to become tradable that weren't. We allow a lot of things in asset classes to become yield bearing that weren't, just because before the settlement times were simply far too long. I mean, you even see this again with money market funds. As soon as you have the ability to take money market funds on chain, the next question is, and the thing that opens up instantly is, oh, we can trade this overnight and we can also trade this on the weekend, right? That to crypto people is like a normal thing. Yes, Bitcoin trades 24/7, right? But the efficiency of capital that allows for is something that institutions haven't been able to see yet. And although that only adds a couple basis points onto every single trade, it's a meaningful yield, right? I think as well, the last thing that they're looking for is increased liquidity. I think they're realizing and accepting that people are starting to move away from banks, right? People are wanting and are starting to trust institutions a lot less. And so people want access to permissionless yield, right? And so they need a place to be able to, they need instruments and products to be able to offer that back to communities. And the only way they can do that is by pairing up with DeFi companies.
And I also think I would just add, I think it's helpful to actually like articulate specific examples of these institutional use cases, right? There's so many different strategies that you're alluding to, Sasha, in terms of trading, market neutral strategies. We've touched on basis funding trades. There's looping trade. There's a whole bunch of different DeFi strategies that different market participants might pursue. From my standpoint, I think there's a few key ones that emerged in 2025 that are worth highlighting. One are obviously the existence of the treasury companies. These are huge, massive pools of capital in the billions of dollars at this point, and really their mandate. Staking is by default. In some ways, you can kind of look at staking as like the risk-free rate of the crypto ecosystem. It's that baseline rate that they want to capture. But the treasury companies want to go beyond that. They don't want to be a pseudo ETF. They need to drive additional value. And so this is like a tangible use case. It's a more institutional use case. A lot of people throw around institutions. I think it's helpful to put more tangible talking points around it. And these treasury companies, billions of dollars of capital, capturing the staking rewards, but then want to go on chain, and maybe they want to go into a looping vault strategy, which essentially is they're borrowing against their staked assets to lever up, stake more, and capture additional rewards. Maybe they want to put on a structured trade like the basis trade. They want to post their staked assets as collateral, and they want to short the futures and ultimately try and capture the basis differential. There's a whole host of different strategies there that I think are starting to emerge. I think additionally, you have others like asset managers that have obviously been putting on a variety of different trades as well. Some of these similar strategies, basis trades, vaults. I think Griffin mentioned earlier, Bitwise and other asset managers are starting to move into the vault curation space. And so I think these are like real use cases that are starting to emerge that are more institutional.
Yeah, and when it comes to liquid staking, how are you guys approaching this, and how important is that institutional liquidity for DeFi markets?
Yeah, institutional liquidity is incredibly important, especially because these institutional use cases are the largest. And so, like I mentioned before, billions of dollars across DATs, billions of dollars across ETF issuers, crypto exchanges, the same thing, billions of dollars of assets held on regulated exchanges like Coinbase and Kraken. And so liquidity is kind of a key fundamental piece there. The Liquid Collective forged a partnership with Galaxy at the end of last year. Galaxy actually acquired the development company for the Liquid Collective, Alluvial. And so now Galaxy is actually the development company for the Liquid Collective going forward, which means they provide human resources, engineers, et cetera, to help continue to build the protocol and also distribute it more widely. So from a liquidity standpoint, they provide not only Galaxy, others like Falcon X and other partners we have too, provide over-the-counter trading facilities that enable institutions to trade at scale. And so I still think it's early days for institutional infrastructure. It still has to get built out a little bit more. But ultimately, institutions need substantial liquidity in order to feel comfortable utilizing DeFi infrastructure.
Yeah, just to build on Chris's point, I think institutional liquidity is really essential for DeFi to be able to mature into its next form effectively. I think for a long time, DeFi has kind of survived and had high yields due to its capital inefficiency, right? And I mean, even now, with things like Hyperliquid, Lighter, with a lot of these perps dexes, the reason why, for example, we at Altura are able to get so much yield from these platforms is because a lot of these are wholly like capital inefficient, right? And that's what we understand currently, and it's exactly why we're starting to look into other primitives that aren't as capital constrained. I think that increased institutional liquidity will either make or break crypto as a use case. I think it'll make it, but I'm biased in saying that. But a lot of institutions believe that it will break it, right? And I think people around this desk are here to effectively prove them wrong. Yeah.
Yeah, and I mean, and there's right the big part. What's interesting, right, is also the fact that DeFi has built new ways of providing liquidity, and sort of packaged it in a big toolbox that's kind of a little bit different and very reusable and universal. So before we move on to more the what's needed for institutions in terms of compliance or transparency, what anything else any of you guys would like to add on this? Or okay, good. So let's move on to compliance, transparency, and trust. Right, when you're an institution, that's something you breathe in and out, every single day. And the first thing is if something happens, how do you isolate risk? So Ayham, how do you guys think about that in lending, and what controls are you able to provide to institutional participants?
Yeah, so it's a lending primitive. You can configure it the way you want or institution wants. So first you offer, like by design, the risk isolation. So that's built in. So that's on a system level that doesn't change. But then institutions want to work around like collateral factors, like how much borrowing power you want to give a certain collateral, liquidation thresholds. And then, of course, when using the lending market, they want to see like a track record of security. And actually, smart contract risk remains the most, I think, the biggest hurdle for institutions, because there's no, like it's an open system. So if something happens, collateral collapse or there's something wrong, and a decimal additional one can really blows up entire system. So it's a huge risk for them. So for them, its track record of security is very important. They need to see audits. They need to see formal verification for the entire system. And specifically, when you set up a market, let's say a lending market, these institutions, they want to see how you've configured the oracles. So can they be changed later if an oracle provider stops providing a feed? For example. So there's a lot of and real-time monitoring, of course, it's super important, but now it's gotten much easier. Incident response processes, they exist in DeFi, but then there's no guarantee that you're going to be faster than the hackers themselves, and often you're not. So there's a lot of complexity around this, and of course, like at Silo, we provide this system that is completely configurable as far as lending, and we provide also support for them. But yeah, it's not an easy landscape, I would say, to navigate, especially for institutions.
Yeah, and how do you think about circuit breakers, or right if something happens?
Yeah, well, it depends on what piece we're talking about. What piece we're talking about. It's very difficult. It's once there's a leakage of value, it's very difficult to stop.
Mm-hmm. Yeah, because everything is so interconnected, and you have a huge network, but then there's more. Typically, there are more things that can be done after the fact than people expect, right?
Absolutely. It's actually, I've been talking to the other day to a major like security firm, and they've been thinking about creating this kind of circuit breakers on a system level. So only certain smart contracts can actually, let's say, borrow from you, and then that unfortunately comes at the expense of interoperability. But then, yeah, that's for sure. If there's a contract that is not recognized, won't be able to interact with your system. So that's kind of like a high level circuit breakers, and I think institutions will likely push in that direction as things mature for them.
Mm-hmm. Yep. And the second theme is sort of like, where do we want the transparency to be in both the movements, but also asset backing? And so, Griffin, curious from your perspective, where is the space going, and how important is on-chain auditability for institutions who are looking at DeFi protocols?
Yeah, I think it's extremely important, and DeFi and being on chain provides the tools for that auditability and transparency. And you could kind of see that with the whole popularity of vaults kind of this year. However, I don't want to act like the industry's always prioritizing this, unfortunately. Like if you look at the unwinding in the wake of October 10th, and all of those black box kind of vaults with recursive leverage and self-backing, people were clearly not prioritizing that, and there was also hidden tranches of debt and whatnot. But I think after those events, it's kind of prompted people to take a much harder look at crypto products and asking themselves where the yield comes from and what is backing it. And so I think being on chain provides those tools, but it's still on the allocators in the market to demand that level of reporting and transparency until like that really just becomes table stakes, which is what it should be. And right now at Reserve, we're really focused on building fully on chain and transparent products, where the entire backing is on chain. On chain. And I think this is where the industry is progressing, and I think the level of visibility that everyone should be demanding.
Mm-hmm. And Matthew, how does Altura manage transparency for on-chain clients?
Yeah, so I guess we are, as Griffin put it, one of these new vaults that kind of prioritizes transparency. So we actually use a platform called Accountable, which publishes our NAV as well as our holdings live every 15 minutes. And so from a client perspective, they can always see what their funds are invested in. But even when using said platform, I think that there's things that Altura is trying to do that sets us kind of apart from the rest of the market, in that when interfacing with institutions, a UI telling you, or even a chain look through of where capital is deployed, a lot of the times isn't enough, right? Like I said, these KYB processes are very, very rigorous. For example, most vaults right now aren't bankruptcy remote, right? So that means regardless of how how good your look through is, like if that vault goes down, if they become insolvent, it's going to be incredibly hard for people to be able to pull out their funds, right? And that's a risk that we like to kind of hide away from in the crypto space, because we're like, well, crypto comes with risk, but I think it's something that we should actually start embracing. Like we should start putting things in SPVs, figure out a way to standardize the structure of an SPV and have that on chain, right? And I think that's what we're trying to do at Altura. What we're trying to do is make our vault as institutional friendly as possible. We want to be effectively like a gray box on their cap table or balance sheet. We want to be as boring and as standard as possible. So for example, on the RWA side, what we're doing is we're making sure that we've got insurance for picking up the gold, for dropping off the gold. We're making sure that we have the cap tables for the ownership of that gold published onto a platform that not just our investors can see, but institutions can see. So I think it's on us to really upgrade our data rooms to really redefine what transparency is because we have the opportunity to do so. NFTs and ERC 1155 are amazing because of the fact that they plug metadata to a token. I think it's an ability we're not using enough in the crypto space. The ability to take off-chain things and plug them into transferable assets on-chain.
Yeah, and I mean that's a whole, all the tokenization aspects are super interesting, and I think that's why also a lot of the big asset managers are really excited about the DeFi space.
Yeah. The last thing I'll say on it as well is that I think the thing that's primarily stopped asset managers from deploying capital is because most crypto firms aren't set up in a way that regulatory-wise you can actually you aren't bankruptcy remote. So just based off of that, we can't actually allocate any capital to you, no matter how much we want to. So I think by just going through those hurdles, by signing up with Wisdom Tree, onboarding, doing KYB, doing AML, doing all of these things, proving source of funds, we can, as a space, be a lot more ready for institutional grade liquidity.
Mm-hmm. So I'd like to use that as a segue to a bit now look ahead and what opportunities and what's going to happen in the space. What would you say are the biggest friction points to getting in adoption from an institutional perspective? And what would be your guess of what's most likely to move on chain in the next year?
I think my guess for what's most likely to move on chain in the next year, I think it's a couple things. I think, like I said, tangible commodities, highly overlooked, incredibly lucrative. I think private credit, right? Private credit is already on chain, but I think it'll become a lot more permissionless, right? If we look at Centrifuge, for example, they're already starting to do this. It's not to the point that I can come in with my MetaMask and onboard through there and buy into a private credit fund, but it is there. It just needs to be a lot more accessible. And then I think once we get these things, I think lending vehicles built around and structured around these new primitives will start to emerge. So think about repo, for example. If we can get on-chain repo by the end of the year, done in a way that I can, with my MetaMask invest and get access to that, that would be wholly amazing. And in the same way, trade financing for again, these exotic primitives like gold, like gemstones, like livestock. A lot of these markets are capital constrained as well. A lot of them have an incredible amount of intermediaries, which means fragmented liquidity, and which means a lot of price discovery once we unlock that liquidity side and once we unlock that reporting side. So I think, yeah, those two.
Yeah, it's kind of funny that we're talking about decent intermediating DeFi as well at some point. Go ahead, Chris.
Yeah, I was just going to add that I touched on this earlier, but I really think as more of this infrastructure is built kind of native DeFi, it's really connecting it. I think the main unlock will be really connecting it through the gatekeepers that the institutional users really come through. So again, we've started to see some of this already happen with custodians and integrating certain DeFi solutions into their platforms. I think we're going to continue to see that. Same thing with vaults, right? I mean, that feels like a very natural integration into qualified custodians to make it more easily accessible, to make it more compliant, to check more of the boxes that these institutions need in order to interact more closely with the DeFi infrastructure. So, and I think it's great to see, I think a variety of different, more institutional players in the crypto space start to try and support that infrastructure and bring it to be more accessible for those folks.
Yeah, I'd say one thing that I think is equally as important as those entry points that Chris is talking about is actual liquidity of these products on chain. Like Sasha, you asked, what we might expect to see tokenized, and I think everything will be tokenized. It's just a question of what has sufficient liquidity to be useful on chain, and to have liquidity enough and deep enough liquidity to be used as building blocks into traditional finance workflows that are now moving on chain. And I think that's really going to be the make or break for a lot of these RWAs, is if they're able to solve for the liquidity, whether it's through market makers or incentivizing on-chain liquidity with retail or something like that. But I see that as the biggest blocker at the moment.
Yep. And Griffin, did you want to chime in? I saw you unmuted.
I'm
Matthew,
sorry.
probably Matthew, you wanted to add something?
No, sorry, I was actually just saying I think it was Ayham that unmuted, but yeah.
Yeah, no, I just want to basically, I can't really add much to say that I think it's probably like token reward asset tokenization is probably what's we're gonna see next big thing in DeFi. I think this year and the next mostly it's going to be around that. Of course, we're going to continue to see stablecoin strategies dominating DeFi, but going forward, I think it's more of the real world assets being used in lending markets in a scalable way.
Mm-hmm. And what is it going to take to really see, like, get DeFi to be seen as core financial infrastructure rather than just a POC or an experimentation ground?
I think it's a lot of things need to happen. Risk frameworks. You have to standardize them, which is quite difficult right now because of assets and how they're built. A lot of assets. Oracle infrastructure. I think from our perspective, also we've seen it as being a major issue at the moment. Transparency tooling and monitoring, I think it's very important. And I think, like you mentioned, Sasha, earlier, like circuit breakers, I think there is no way around it. We have to build something around this. For example, like one of the biggest problems in lending markets, you cannot unwind them. If there's let's say a bad debt or something, their collateral is stuck, debt cannot be repaid. So with SADO v3, we actually introduce an unwind mechanism to really just unwind the collateral. We swap it to debt, and then we just unwind the market. So yeah, there's a lot of stuff that need to happen in infrastructure wise for DeFi in order for institutions to move from this experimentation to real adoption.
I think institutions will, I think the major institutions will find it hard to participate, again, if the regulatory environment isn't, if we don't engage with the regulatory environment properly on their terms. So what I mean by that is, again, we as a community can have all of the amazingly yielding products we want, but fundamentally, if we can't prove source of funds, then we won't be able to invest in the majority of institutional grade products, right? So I think it's the really, really simple things that mean that a lot of firms just get X'd off the page really, really quickly. I think the next thing for institutions to want to engage a lot more is transparency that goes past the tech, right? So I think the problem with DeFi a lot of the time is we believe as a community, because we are a community of engineers, there's a technical solution for everything. For some things, there just isn't, And I think by accepting those risks, by accepting, for example, that counterparty risk is a material thing that cannot be put into a smart contract, right? It moves us forward, it matures us, and it allows us to deal with those risks in a proper professional manner. Yeah.
Wonderful. So I think we're getting on time. So to wrap, unless anyone wants to add anything, To wrap this up, I suggest we go around the table and if you could share what milestones or initiatives our listeners should be on the lookout for in the upcoming year from your teams. And also if you want to share where people can find you. Griffin, if you want to get started.
Yeah, happy to. I think one thing we are excited about at Reserve is as regulatory guidance continues to progress and RWAs continue to advance, and we have more different types of assets tokenized on chain, I think we will see reserve indexes that blend TradFi RWAs and crypto assets to create products that couldn't previously exist on traditional rails because they have different differences in liquidity, differences in settlement times, or previously existed across TradFi and DeFi. And so you can think about a product like with a basket of Bitcoin, tokenized treasuries, tokenized gold, and tokenized S&P 500, all bundled into a basket. And really creating these diversified products that's massively simplify how users invest and manage their portfolio, and even have programmable rules around buying and selling, which I think is all things that we're very excited about and looking forward to developing.
Mm-hmm. And Matthew? Or sorry, Ayham, I think I saw you just unmuted.
No, sorry.
Matthew
can go. Okay, maybe I can go first. Then, yeah, for sure. Very quickly. Silo V3, again, like I mentioned earlier, we now with the V3, we can create lending markets for really any asset. We do not need for that asset to have any liquidity or instant redemption mechanism. So tokenized gold can immediately have a lending market because of thanks to the way that we've designed lenders protection and liquidation mechanisms. Of course, this comes with a completely new lending app. We're introducing risk scoring and risk transparency, so lenders and borrowers will be able to see how this asset can be liquidated, if there's an admin on the collateral side, if there can be infinite minted, for example, lots and lots of risk parameters that we display, because we want users to choose these lending markets, isolated lending markets based on fundamentals. So yeah, that's coming in a few weeks.
I would say on Altura's side, it's trade financing. I think that vaults are an incredible way or incredible new way to do that, right? And I think people don't really recognize what we're doing, right? We've effectively tokenized trade financing and made it permissionless, right? Which to me is magical, because I think if you have a strategy that can genuinely generate yield, then you should have the capital to be able to execute on that strategy. And there shouldn't be anything that constrains that yield. The capital shouldn't be the constraining factor. You should be allocated as much as your strategy can perform up to, right? I think vaults need to start being greedy at looking for new primitives. Everybody's kind of playing in the same spaces and biting off of each other. Market making on OKX, Hyperliquid, and Lighter is great, but there's more to be done, right? RWAs are coming in. They've been coming in the past couple of years. They're coming in this year in a big way, and we're finally able to start playing in these spaces. And we're able to do so in a way that settles faster and is actually more liquid, has more velocity, right? If you look at liquidity that way. And then I would say exploiting, again, liquidity constrained environments in the real world, right? So RWAs like gemstones, livestock, et cetera, that are extremely fragmented, but are extremely deep in terms of liquidity, right? I think are really prime targets to start to go at, because again, they're primitives that haven't been touched before, and the price discovery because of the fragmentation of liquidity is massive. So yeah.
And yeah, from the Liquid Collective side, Liquid Collective started as a collaborative effort between Coinbase, Kraken, and Figment, and since then it's expanded to include Anchorage and now Galaxy and others. And so my focus is expanding the consortium to other larger institutional participants, some of these more traditional financial institutions that we've been talking about today, and ensuring that institutional liquid staking is fully embedded into the capital markets infrastructure that those institutional participants used, like custody and the DeFi infrastructure. And then secondly is building liquidity. More adoption means more volume, which means more integrated markets. We talked about liquidity a lot. You need really robust liquidity to actually support these super substantial, large institutional use cases. So expansion of the consortium and expansion of our liquidity profile is the focus.
Wonderful. Well, thank you so much to all of you for joining this panel and enlightening us on institutional DeFi. Thank you to everybody who's been listening live and people who are listening to the replays on YouTube, etc. And this concludes today's the TAI Innovator Webinar series. So thanks everyone, and see you next time.